Good morning, ladies and gentlemen, and welcome to the show on this Tuesday, the 18th of January, 2022. Thank you for tuning in. Glad to have you guys here. Now, you've heard me talking about the Fed playing this game of chicken. Everything's coming just as anticipated. I anticipated this market downturn. A lot of these other guys are saying, hey, it's going to go up higher. And, an awful lot of these other guys, too, are saying, hey, the market, it's going to go down by 80-90%. So you have these two diametrically opposing opinions out there. Neither one of them's right. I'm pretty much hitting it right on the money, and have been for a long time on my channel. So you guys knew. If you're listening to me, I told you when this is coming, and I'm going to tell you exactly what's going on. The Fed could turn at any time now. Now the markets are starting to go down. They could change monetary policy. Their policies are something called data dependent. The big question mark is how far are they willing to let all this go before they turn? They're watching it very carefully right now. They're going to turn because these markets, they could go down. The bottom's so far down there, it's not even funny. And normally, when they get a downturn in the markets and they get bad news around the world like Evergrande and the Chinese property development market, and what the Chinese are doing right now with these zero COVID policies, how this is going to affect the all the things that come from China are going to start to be affected. If you need a part to fix your car or whatever, because an awful lot of, parts and stuff and things to keep the machinery and oiled and keep things working in the United States of America come from China, from importers. There's really bad news, and we've been through a period of about a couple years there where bad news was good news for the markets. And this is because the Fed put was there, and they realized that the Fed put will only get stronger on bad news to drive the markets up higher. Suddenly that's not there. And so bad news is going to start to become really bad news. Bad news will be bad news instead of good news for the markets. We're going to see this downwards. Like I told you guys, you're going to see up days in the market. But the down days are going to be bigger. And this is going to continue until the Fed turns. It's going to create buying opportunities for you guys. I'm thinking in my mind a big flashing neon sign that says cryptocurrencies, buying opportunities coming up straight ahead. You guys got to find your entry point, but you're going to make some, when Bitcoin and the cryptos all hit their bottom in all this, and because they're a risk-on asset, risk-on is now risk-off. I mean, they're not buying risk-on assets anymore. This is going to be something that you need to watch and find your entry point, and you could make some, because I believe that crypto's got this downward trend is going to continue until the Fed turns and changes direction, and then it's going to be off to the moon for cryptos, off to the moon for gold and silver. Now, I also told you guys in my show that I didn't know which way gold and silver were going to turn in this. Well, it seems like in the initial start of it now, gold and silver starting to turn up a little bit. Will that direction continue? Very possibly. So gold and silver are going to remain a bargain to buy until the price of silver gets over $50. It's still a bargain. When it gets up around $50, it's still going to be a bargain to buy. We're moving into a commodity cycle that is going to be bullish on commodities, very bullish on commodities. It's almost like a super cycle that's coming for commodities, and gold and silver are commodities. because they're not used for money anymore, at least in most places. They are a commodity. We're going to see commodity prices explode to the upside, along with hyperinflation. And you know what? I know interest rates are going up right now, guys, but prepare yourself for negative interest rates. And, I don't understand myself exactly how negative interest rates are going to work. It's so foreign to the but I'm actually expecting rates to go negative, because they're going to have to bring these rates down, and there's no other way around it. Rates are creeping up. Anyway, let's get in there and take a look at what's going on, and let's open up the charts right here and take a look here. Looky, okay, here we are. Here we are at silver. What's this flashing up this page? 23.37 today for silver. It's up 38 cents on the day so far. So it's holding up above $23, which is very good. Now this is the paper price for silver. I've been pointing out a coming silver shortage for a very long time. It's gonna get here, and when it gets here, we're gonna see tremendous moves to the upside, because silver is really what we're talking about here is a market that is just a derivatives market. That's all this is. The spot price of silver is a derivatives market. But there's a real underlying asset class here, which is the actual physical silver. And one doesn't reflect upon the other, and it hasn't for a very long time. And this is why these prices are down so low. I say low, but because everything else has went up in price to match the rate of inflation. But this has been kept suppressed using the paper silver derivatives contracts. This makes this a terrific buying opportunity if you take delivery of the physical. This is a long-term hold. It's not for you guys out there who just want to turn a quick profit. Over the next number of years, if you're holding this, it's going to do really, really well, silver. Because there's limited amounts of real silver in the ground. And, this price here, this spot price, could become irrelevant, could be meaningless at a certain point in time. And not in the far too distant future either, if they start to run out of the physical supply. This price could actually go to zero, just like oil. Oil went negative, $40 a barrel. That's unbelievable that actually happened. It's almost like so bizarre when oil price went down below $40 a barrel. That was unbelievable. Anyway, it did though. And this is what can happen in these derivatives markets. But that doesn't mean that the actual physical price would go to zero. No. The price of physical could be astronomically high at the same time your paper short contracts are worth nothing. Because all they are is paper. If they can't back them up with real physical metal, what are they worth? All those paper short contracts. They're not worth anything. It's the real physical metal that's worth something. Anyway, so what I'm saying is there could be a complete detachment from the paper short contracts in the real physical metal. Complete and utter detachment. So that that's what we are actually seeing, is this detachment happening when we see the premiums on the physical metal, which we're getting used to now, Anyway, gold's at $1,811. Let's take a look now at cryptocurrencies today. 1980, 1967, so it's moving down. Bitcoin price of 41,503. I'm expecting that if the Fed is a bit sticky at being a holdout, we could see like a $29,000 price on Bitcoin before this is over, before the Fed turns and changes direction. Maybe, I don't know, March, April, May, they might turn and change direction. And it could very well be that before the end of the year, we might have a Bitcoin that's well in excess of $100,000. So that's why I'm saying this is a buying opportunity. But it's all hinging on the Fed changing from being hawkish and being tight with the money to being loose monetary policy again, and going back to loose monetary policy, swinging. In other words, the Fed swinging. That's what this is dependent upon. And how long is the Fed going to hang in there? Well, they could turn any time now. I mean, even these little turns down in the market that we're having right now could trigger them because they're data dependent. I guarantee you they're going to get triggered when the market's down 20% or 30%. How far are they willing to let this go? Because it's going to take more money to turn it around and bring it back. You know, they're letting go of the rope. And it's just like a game of tug of war, you know. If you let go of the rope for even 1 second, you're going to have to pull that much harder to bring it back. In fact, you might lose the tug of war. That's the thing, you know. Anyway, it's a dangerous game the Fed's playing right now, and they're playing it with all of our lives. Because what they could do is trigger not a recession, but a depression. A very deep, dark depression they could trigger by doing what they're doing right now. And the big question mark is, in my mind, is, are they doing this on purpose or what? I just don't know. I'm just asking that question. Let's take a look now at the Dow Jones, which is down 526 points on the day. The crash is beginning, and, you know, I'm going to tell you guys, I forecast this crash, and I had it right on the money, where a lot of these guys are saying, no, the market's going to go down by 90%. No, it isn't. And these other guys out there who are saying, hey, the market's still going to go up, we're in a new paradigm, this is something that hasn't either. They were wrong too. They're all wrong. Wrong. I'm telling you guys, this market is probably, I'm predicting it's probably going to go down. I'm thinking it could happen anytime the Fed could turn, but I'm thinking they're going to let it go down. We could see a market even go sub 30,000 into the 20s. We could see like a 29,000 on that before the Fed turns on the Dow. Heck, we could even see it go down to 25,000 before they turn. But, you know, I guarantee you they're going to turn, because this would go down to 12,000, 8,000. There's nothing in there but air. It just goes no bid at a certain point. Because once you flush out all of these dip buyers, what do you got left? You're like Wile E. Coyote when he runs out over the cliff, you know, and he stops there for a second. He has his eyes wide open like that, and he's like, well, and all of a sudden, he hangs there in midair for a second before he falls. That's what happens when the dip buyers all leave this market. And it goes no bid. So it could really crash out of bed really fast, you know. Down 526 today, but, you know, this is... And I mean, you know, you get these things where it could bounce back 300 tomorrow, and then a couple days goes by, and then it goes down another 500 or 600, you know, on whatever bad news comes out of, say, China. Good news come out of China. China is just, right now, it's a wrecking ball, you know. And I haven't heard news on Ukraine this morning. Got to check into that situation, but that's just a hotbed brewing and steaming over there. Anyway, let's take a look now at crude oil, $85 a barrel. Wow. It's going to go up and up and up at the pumps. It keeps going like this. And this is a strong indicator. Crude oil is a very strong indicator for me. and that we're entering into this commodity bull cycle. We're coming to it. We're not there yet, but it's coming, which is going to see very big rewards on gold and silver. You see, the difference between cryptocurrencies and gold and silver is it's all about risk and reward. I see gold and silver, if you get the real physical metal, as having very limited risk. Cryptocurrencies is big risk, but on the other side of that, it's big reward. So it depends. And not only that, cryptocurrencies are not real stable. Like, I mean, they can lose 10% in a day, or they can go up 20% in a day, you know. And gold and silver, a little bit more boring to go into the gold and silver, but your money is not so much at risk, you know. I consider the dollar the biggest risk asset out there right now. All determined by the whim of the Fed, you know. And oh, here's another thing I want to point out to you guys. The Fed has helped all these rich guys out there to get bags and bags of money. So now picture in your mind a rich guy sitting out there on thousands of bags of money. He's got all these money bags, right? That money doesn't represent anything real. It's just paper. Big pile of paper. He's sitting on all these bags full of money. The Fed is creating buying opportunities for the rich that are coming up very soon to transfer that money into something real, whether it's real estate, whether it's precious metals, whether it's cryptocurrencies. They're creating a buying opportunity for all that money that's sitting on the sidelines. If they start to crash the economy, crash everything. Not buying opportunities in the things that the price is going up on. Things that are like necessities of life, you know. There's not buying opportunities in that. Price has been going up steadily on things like food. But buying opportunities in things that are like, they could create a fire sale on an awful lot of items. If we get a really serious downturn and we get a depression that's starting. So, see, what we got right now is what's called stagflation. We got inflation going up on all the things you need. Prices are going up. At the same time, financial markets are starting to turn downwards. This is very hard to live through a period of severe stagflation. And they're heaping this on us. Okay, let's take a look now at, we've seen crude oil. Let's take a look at the MOVE index. The MOVE index is a 76.59 and going along sideways. And now we're going to take a look at bonds and rates. I thought the bonds had cooled off. I thought they'd priced in the first one and we weren't going to get these moves to the upside. I mean yields rising. Until the next one, until the next cut. Well, we're at 1.84. So I was expecting it to stay back in the 1.6s or 1.7s on the 10-year. It's at 1.84. Maybe they're pricing in the second cut a little bit ahead of time. But, you know, it's probably going to bust through that 2% marker. And on other shows I've done, I've set the price at 2.25, where it's going to start to really affect things in a very negative way. Okay? So keep your eye on that. As it creeps up, markets are going to become more unstable. It has a very profound effect upon the market. Take a look at the dollar index today at 95.74 and climbing. This is not unexpected. I expect this will continue as long as we start to move toward this period of, it's not deflation yet. But see, we could get an interesting, curious phenomenon where the price of things continue to rise on all things you need, like food and things like that. Gas, food, and everything else. At the same time, the financial system is deflating. So we'd have inflation in the general economy on goods and services. CPI going up. And the world's economy sinking. The economic side, the Wall Street side of the economy, deflating. In fact, that's what we got today. And this effect could get much greater. Wow, what a time we live in. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.